welcome back to the second video in the risk management series. It's been a little while since the last video, but I think this one's going to be quite informative. I dropped that I'm going to be talking about some smart money concepts because a lot of people want to get into leverage trading or futures, and I thought this sort of content might be a lot more useful in practicality. So I'm going to be getting into more of the specifics on the charts rather than just the theory and understanding the knowledge that I've been giving you guys. So let's get into it. So this one's about stop loss and invalidations. So first of all, what's a stop loss? Everyone's probably heard of what a stop loss is, or at least heard of the term. You've got a picture over here. So in very simple terms, there's three main points that you have to concentrate on in this thing. You might see this on other people's setups and charts, right? So this line here is grey, is your buy price. So imagine this was a long position, sorry. So you bought into this position. So this is the buy price, this is the profit price, and this is your stop loss. If price was to go down here and hit this price, you have a stop loss, meaning the order would have been stopped. You would have bought, you would have had, I'm not going to say small loss because it depends what type of money you're playing with, but you would have had a loss at this point, or as shown in this example, price carried on upwards and it hit your take profit, and you would have made a decent amount of profit here. So over here, stop loss is type of order that's commonly used by traders. The order stops your loss at a given level to ensure you do not hold your position into further drawdown. A key part of risk management as it ensures that you can take calculated losses. So just as I said before, I wasn't going to say that you might take a big or a small loss, right? That all comes under risk management. If you can calculate your losses, you're not going to be taking anything that's too heavy. You can make sure that, whatever you're risking or losing is already calculated and it's not going to hurt you. Over here, so of course, this was our entry price, right? So let's imagine we bought in over here, as shown in the example. So the chart that I took this example from, we flipped a key level here. And of course, that's why I would have bought in, right? So over here, when price is under the gray line, this is called drawdown. When your trade or your position rather goes into loss, of course, you haven't cashed out yet, but it's in loss. It might say -$10, -20, whatever. That itself is called drawdown. Over here, of course, when we go into the green zone, you're in profit. When you're in drawdown, you're in the spread zone, which is your loss zone. Hope all of that makes sense. Okay, so I've just pulled up a random chart here. This is Telcoin, Tel USDT, right? So I want to show you guys first how to actually use the tool. I'm assuming a lot of people do use TradingView, so if you do, this will be very useful for you. So over here, if you come to the left, you've got these things. In this one here, you can click it. You've got a long position or a short position. If you didn't know, long just means buy and short means sell, right? I'm just going to get both on my chart quickly. So we just put on here, got on here. Okay. So of course you got your two positions, right? Don't worry about the price at the moment. I'm just going to show you what it looks like before we actually apply it to the chart. So what's really important about this, if I just zoom in a little, when you hover over this, it tells you your ratio. So of course, if I move my stop loss, you can see the ratio just increase and increase and increase. And the lower I go, the higher the ratio goes, right? That's called your risk to reward ratio, as it says. Okay, so that's something very important to remember. A lot of people refer to that as RR. Another thing, well, I'm going to speak about that later, but another thing is your percentages, right? So it shows you here how much of the price movement that's happening is happening as a percentage, if that makes sense. So essentially, let's just apply it to the chart so it gets easier to understand, right? Okay, I want you guys to imagine that, let's say we had this position set up. We bought in, okay, yeah, let's say we bought in around here. Our stop loss is, if we just do some really, really quick rough analysis, we've got a bit of a resistance there, a previous resistance, sorry, so current support, let's say, that got flipped. So let's say our stop loss is just under the resistance, right? And now this here is another key level. Let's say we're going to trade to up there. So this trade was a 4.7, right? So it hit take profit fairly quick. This is very, very quick. This hit in the space of about just under, probably about an hour and a half, right? Okay, anyways, the relevant points is this trade here, your stop loss was 1% and your profit was about 5%, let's say, right? So what's important with this, it can help you calculate how much you're risking. So now I want you guys to imagine, let's say we put $100 into this trade, right? $100. On your spot trading, you haven't made much, right? So a lot of people will leverage trade. So on leverage trading, let's imagine you're using 10x. If you're using 10x, then it becomes easier for you to understand how much you're actually risking, right? So if you use this setup and your stop loss is 1%, or well, roughly 1% here, and you use 10x, it turns into 10%. And your take profit, where it's 5% times by 10, because you're using 10x leverage, turns into 50%. So in this trade, you would have either potentially lost $10 or you would have made 50 starting with $100, right? So this is why being able to use this onto your charts literally is very useful. Not even a stop loss, but just being able to draw on your setups. Now, second of all, the actual point, your stop loss, right? This is what's important. I said we're using $100 trade in my example, right? Now, everyone's going to have a different account size. Everyone's going to have a different appetite for loss. You don't know, or well, you need to figure out how much you're willing to lose in a trade. If you're only willing to lose $20, $30, and you know that now you've made your setup, you found everything, and your stop loss is 1%, and you're only willing to lose $20, $30, right? Then you could have used 20, 30x leverage potentially in that trade. You would have made a lot more as well, right? I'm not saying use higher leverage purely because you're going to make more. You're going to take losses as well. So you have to remain calculated. You have to figure out how much loss you're risking here. First as a percentage, and then use this to actually convert it over to real money and understand, okay, a 1% loss, but what does 1% actually mean? 1% could mean, for one person, it could mean you're losing $1,000 if they got a massive account, but for another person, it could mean you're losing, I don't know, let's say $10. So forth, according to the leverage you're using and how much you're willing to lose, you have to figure out where your stop loss and where your take profit should sit. Hope all of that makes sense. So now on to the next point. So the next thing I like to talk about is setup and validation. So setup and validation will help you figure out where to actually place your stop losses. It will give you a reason to put them in certain places, right? So usually in validation, what I mean by validation is that it's the level at which your setup is wrong. So that, to some of you, depending on how you trade, may not make sense yet, but I'm going to show you on the charts in a second. But essentially, there's going to be a certain point that price either closes at, touches, moves towards, that will make you think, okay, no, my bias, for example, if your bias is bullish or bearish, let's say I'm bullish, price moves down and breaks a certain level, and I'm like, okay, my bias was wrong, price is bearish, it's not bullish, my setup's wrong, right? The next example of invalidation is invalidation via strategies, right? Each strategy works differently. I'm going to show you examples of two very briefly. And of course, there's going to be a million other examples as well. But with the strategies, there's certain ways that they work that will essentially let you know where you're wrong, that the strategy doesn't apply or your whole setup's invalidated, so you can just get out of the trade. And then the third point is using your setup invalidation level as your stop loss gives you a trade space to breathe. Usually, what this means is a lot of people use tight stop losses because they like to have good risk to reward ratios. But if you're using invalidation levels as your stop loss instead, it means you're only getting stopped out when you're wrong. You're not getting stopped out early because you decided to keep a tight stop loss purely because you wanted a good ratio, purely because you wanted to see a 1 to 20 RR instead of just, going for a 1 to 4, 1 to 3 and having that wider stop loss. So let's just get on the charts. Okay, so back on Telcoin, again, same chart. So first thing I want to speak about quickly, Elliott wave theory. I've covered this in my other videos. One I'm about to just quickly cover, it might not make sense if you're not familiar with it. If you want to get into it, you can watch my other videos and it will make a lot more sense. But I'll try to keep it as simple as possible, so it's just easier for everyone to understand, right? So on this specific chart, there's no clear example that I can find at the moment. I'm not really going to bother finding one, but I'm just quickly going to show you guys. So with Elliott wave, simplest thing, you got 1, 2, 3, 4, 5. That was a horrible drawing, sorry. Okay, let's say about there. So one very, very basic rule of Elliott wave is that wave 2, so this line, price cannot cross below wave 1. So if we just quickly draw on, so that's our base level. If wave 2 was to even wick below this price, depending on how you trade actually, but if wave 2 was to move lower than this price, and you see something like this, your setup's invalidated. Your wave 3, your wave 4, your wave 5, you probably should not expect to see that. There's a possibility that you might be wrong, but this is just a very basic, probably one of the most basic rules of Elliott wave theory. If wave 2 breaks past the start of wave 1, then your whole setup's invalidated. So what does that mean? So that means if, let's just imagine now, we're going to use our trading setups, not short, sorry, it's a long. Just come over here. So we long. Okay, so now what happens is you know that price has moved up to wave 1, right? And of course, using Elliott wave calculations, price is meant to come to a certain price point, right? I know that might not make sense, but usually, if I just quickly just show you, what happens is in Elliott wave, price moves from here to here. So price will move from. Usually, what happens is your wave 2 comes to usually somewhere around here, roughly, if I remember correctly, the 38.2, right? We can get rid of our fibs. So now what happens is you're looking to enter this trade at around here. A little more up. Let's just say roughly you're entering the trade there, right? Now what happens is you put your stop loss right there, just under the start of your wave 1. Why? Because I just explained to you guys that usually what happens is if your wave 2 violates this level, if wave 2 comes below this level, your whole setup is invalid, right? Usually wave 2 can come deeper, right? So I said wave 2 comes to the 38.2. It's possible wave 2 comes to the next level. Wave 2 comes somewhere down here. But as long as it doesn't break the start of wave 1, then it's fine. Your setup is still invalid. But when it does, then your setup's invalidated. So all that means is you have clear logic behind your trade. You have reasoning for putting your stop loss in a certain place. Don't put stop losses there randomly, without the given reasoning. And of course, with Elliott wave theory, it's quite straightforward. If this rule is broken, then clearly your trade's invalid. So now I'm going to show you guys quickly with the Ichimoku. So again, you might not be familiar with this. I have posted videos about Ichimoku on my channel, explain how it works, how I use it sometimes. So a very, very basic way to trade Ichimoku. When price closes outside the cloud, right? What you expect is, this is just one strategy that people use, a very common one that I've seen at least. You expect price to make a 1 to 2 move. So usually what they'll do is, let's say price closes outside the cloud, you enter at the candle close, you enter about there, you go for, so of course I explained to you guys that the ratio is shown here. So what I do is put my stop loss around here, just under that previous candle, sorry, around there, let's say. This is a very basic way to do it. So of course I know some of you guys watching this video might trade in more complex ways and use other strategies, and essentially you need to go and figure out how invalidation within your own strategy or theory works. But I'm just showing you in practical examples, so it's easy to see why stop losses are in certain places or not. So of course I said I'll go for a 1 to 2. If I go for a 1 to 2, it's about there. That was a super easy trade. Your stop loss is there because once prices close outside the cloud, you expect a 1 to 2 move without price coming back in the cloud, right? So what would invalidate my setup here? With the Ichimoku, usually what happens is if price closes inside the cloud, you expect to move to the other side of the cloud. So here, of course, price, as you can see, we closed outside right at this candle, and we moved up, which is expected, which is usually what happens, right? But other times, what could have possibly happened, you could have just seen something like price coming straight back inside, and then you'd expect to move to about there. So something like that. That's basically what you would have been looking for. You would have been looking for, if price closed back inside, then I would have ended my trade. So essentially what I'm trying to say is, before I just showed you guys quickly a setup around here, and my stop loss was here. We'll do it down here, right? And I'm risking whatever amount. Here's 2%. The point is, if price closed here, if price closed somewhere inside there, inside this Kumo cloud, so if I just get rid of this so it's easy to see, if price closed here, or even inside here, I would have ended my trade. For me personally, the way I trade the Ichimoku, I don't need to wait for price to come and hit my stop loss. My stop loss was there because that was a previous key level, and I've put it just below that because I expect price to bounce there. But with the way I trade the Ichimoku, if we close back inside, I'm expecting to move from here to there, and my stop loss is here. So why am I going to wait for price to come and hit my stop loss when I can just cut my losses early, if that makes sense, right? So of course your stop loss is there, but using your strategies, your indicators, whatever, if price seems to behave in a certain way, you expect a certain thing, you don't need to wait for it to come and hit your stop loss. You should know when to cut your losses early. That's a key part of risk management. A lot of people have the hope, okay, my stop loss is in place, I can just wait for it to stop me out, reverse, I'm risking a certain amount. That's fair. Of course, if you're using logic behind your stop losses, cool, it makes sense. You're waiting for your setup to get validated before you cut your losses. But if you're seeing clear signs of reversal, if you're seeing some sort of economic news dropping, for example, with crypto, especially in specific, you see Bitcoin dumping and you're in a long position on whatever coin, it will be very, very rare that the coins, especially in this current market climate, won't be moving with Bitcoin, right? Because most of the time, they will be moving with Bitcoin. If Bitcoin's dumping, these alts will be dumping. Most of the time, they'll be dumping harder than Bitcoin itself as well. So you have to factor in these little things with your stop loss and cut your trades early if needs be. Don't just wait for your stop loss to always get hit, but a stop loss is necessary. Please don't trade without a stop loss. Imagine, just quickly, just a good example that I can just see with my eyes. I'm just going to delete these other lines quickly so it's clearer, right? So we see this price level here. There was a bit of a resistance right there, yeah? A lot of people don't even trade support resistance. I don't myself anymore, but I can see it, so it's quite clear. So imagine you're thinking, okay, when price gets to this level, we're going to enter a short. This is the previous high, so let's put a stop loss here, right? Actually, you know what? For the example, let's just imagine you were targeting this and you don't have a stop loss. You have no stop loss. You literally just open a trade and you're not using a stop loss, because I'm going to show you the importance of using a stop loss, right? You don't have a stop loss, you would have entered, let's say around here, right? Your trade, you expected price to hit this resistance and come straight back down, but look what happened. So now, sorry, 1 second. So now what's happening is, if it lets me do it, okay, I'm gonna put on the chart again. So now what would have happened is that you would have ended up in about, or at the highest point, you would have had about 15% loss, and that is on spot trading, right? So this is just normal charts. So now here, if you used any leverage, if you used even 5x, right? Even 5x, you would have been at minus 75% in your position. If you used any higher than 6x, you would have got liquidated, meaning your whole position would have essentially just gone. It would have disappeared because all your money would have been lost. So this is the importance of using a stop loss. If you use your stop loss somewhere down here, which is reasonable, logical, because of course there's a previous high, you put it just above the previous high. You know, your take profit is here. It's a good 1 to 3 trade. It's a fair setup. Understandably, here you got stopped out. But of course, because you calculated all your risk, all your how much you're willing to lose, you would have been all right. You probably wouldn't have come out of it too bad. I feel like I've rambled on a bit here, but just some last key points that I want to make. When you're making your stop losses, this is one of the first points that I mentioned. You have to risk an amount that you can handle. If you're risking a massive amount, if you only have $1,000 in your account, for example, and then you go ahead and in one trade, you're going and risking $500. That's crazy. I can't imagine a lot of traders that will take a 50% loss and then be able to trade as normal for the remainder of the day or the next day or even the week. You have to trade according to how much your portfolio is, like the size of the trades you're taking, and the losses you're taking shouldn't be big. Even if you have $1,000 in your account, put $100 into a trade. If you take a $20 loss, that's barely anything, right? And it probably won't affect you. If anything, you're going to take that loss, you're going to look at your setup, you're going to learn from it. If you take a massive loss, if you take a $300, $400 loss, because either you're using a massive stop loss or you're not using one at all, so then you're having to close your trade automatically with a big loss, you're not going to be in the correct mindset. So this is essentially the last point as well about the mental aspect. You're not going to be in the correct mindset to be able to, learn from your trade, see what went wrong, all of that, all of these other things that are part of trading. You won't be able to go through them properly if you're not managing your risk, if you're not using the correct stop losses. So the second thing, in risk management, your losses to wins are. So I spoke about risk to reward ratio shown on your trading view setups as well. When you have your trades, you have a certain RR. You realistically want to take trades with higher RR, but you can't force it. Don't always look for massive RRs. But essentially, if your R, the number R, imagine for you R stands for, let's say, $50. So if you have a 1 to 10 trade, what that means is you either lose $50 or you make $500, which is very good. So with your R, if it remains consistent, what this means is if today you won a 1 to 10 trade and then tomorrow you had a 1 to 5 but you lost it, technically you're still up 9 Rs, if that makes sense. That means you're still $450 in profit. You lost $50 the next day, but it's fine because when you're using the correct risk to reward, and if you're taking setups above, let's say 1 to 3 is the minimum that you take. If you find a setup and it's not higher than 1 to 3 ratio, you won't take it. Then what should be happening is it takes you 3 losses back to back and 1 winning trade to be break even. So that's just something to think about. Most of the time, what that means is you can afford to lose a couple trades, which probably is unlikely. You probably won't be losing a lot of trades back to back to back. And if you are, you need to step back. You need, figure things out. That's a bit of a topic to discuss another day. But what it means is you can take a few losses and then have 1 win and still be at a decent point or not being lost, right? And again, mental aspect. When you set a stop loss, you have logic and reasoning behind your trade. For yourself, that brings you peace of mind. You can understand that, I put this stop loss here because blah, blah, blah. It invalidates my Elliott wave theory. It invalidates my setup because of the Ichimoku. When you have logic behind your trades, it's harder to essentially swallow your losses, to kind of digest them and understand why it happened. But knowing that you're risking the correct amount as well, it won't play with your emotions. It's going to make sure that, you're not that person that's constantly checking your phone, and you're going to be able to build trust in yourself to set trades and just leave them there because, even if it does hit your stop loss, you didn't risk an amount that you can't afford to risk. didn't risk an amount that's going to toy with your emotions. So at the end of the day, even if it does hit your stop loss, you should come out fine. But that's everything from me, guys. Here's all my socials. Any questions, anything at all, just message me, and hopefully I'm going to be back with the next video very soon.